I mentioned the two gentlemen in the title because they're among the best and brightest, and I have huge respect for them, and that's why I even bother to make this recording. In the last few months, there have been some epic short squeezes in the stock market, and I've heard a number of brilliant people say a similar thing that is not correct. Here's an example of what I'm talking about.
The biggest short in the United States is Gamestop. Gamestop is short interest exceeds 100% of its float. That's how big it is. Now, technically it shouldn't do that, but it does happen occasionally because you shouldn't be selling naked shorts, which is essentially what they're doing. You should be borrowing the shares that you sell, and it's been caught in an epic short squeeze that's been compared to the biggest short squeeze anybody's ever seen was Volkswagen in 2018, which is referred to as the infinity squeeze. And this might be in some kind of infinity squeeze.
By the way, regarding the Volkswagen squeeze that Bianco mentions, in case you're looking at a chart, he meant to say that it was in 2008, not 2018. Let's examine what he's saying here for a moment. He says that there's something technically wrong with shorting more shares of a stock than exist in the float, but let's just expand that and just use shares outstanding for simplicity. So for example, let's say there are 100 shares of a stock and there are more than 100 shares of the stock that are short, that should somehow be illegal, or that it should somehow be technically not possible, or a sign that the system is breaking down in some way. And I'm going to explain that there is absolutely nothing technically or operationally wrong with shorting more shares of a company than exist, as perverse as that might sound. Remember, an example of shorting is if you borrow a stock from me, you don't own it, you borrow it from me, and you sell it at, let's say, $100 per share, with the hope that the price will go down and you can buy it at, let's say, $90 a share and return the shares back to me. You sold it at $100, you bought it at $90, and so you made $10 times the number of shares you shorted. It's critical to understand anyone who is short a stock must buy that stock back at some point in the future to close the transaction and return the shares that the short seller borrowed. Let me remember to say that this is not investment advice. So what's the issue? I'm going to make a statement that will sound sensible, but it's wrong. Let's say company XYZ has 100 shares outstanding, and there are 120 shares that are short. I just explained to you that shorts ultimately have to buy shares to close out their position and return the borrow. Well, if we know that short sellers have to buy 120 shares at some point, and there are only 100 shares outstanding, then clearly that's impossible, right? How can shorts buy 120 shares if only 100 shares exist, right? Are you sure? Here's a very simple example that I think will go straight to my point regarding why that thinking is wrong. Let's say in my little example, there are 100 shares outstanding of a publicly traded stock, and no one can own more than one share, and there are no fractional shares. So there are 100 shares outstanding, and there are 100 people who own one share each. Very simple. If you asked everyone on the planet if they own shares of company XYZ, 100 people would say yes. Next, in my little example, 20 shares of XYZ are borrowed by short sellers, and those shares are sold short. Who are they sold to? Other buyers. So now, if you ask everyone on the planet if they own shares of XYZ, 120 people are going to say that they do. So pay attention to that point. Even though there are only 100 shares outstanding, there are 120 owners for a total of 120 shares, one share each. If another 80 shares are borrowed and sold short, now there are 80 more people who own the stock. So if you ask everyone on the planet if they own XYZ, 200 people will say yes, they own XYZ. There are 100 shares outstanding, yet 200 people will say they own one share, so 200 shares total. And further, if someone borrows 20 shares and short sells those 20 shares to new buyers, and now you ask everyone on the planet if they own XYZ, there will be 220 people who say they own shares of XYZ, even though there are only 100 shares outstanding. So let's recap what's happened here. 120 shares have been sold short, and yet there are only 100 shares outstanding. In my little example that I've just laid out, every share has been borrowed, every share has been delivered, there are no failures to deliver, and no rules have been broken. This is where the analysis that I hear breaks down. Jim Bianco only makes this point in passing, but if I could speak to him and challenge him, I suspect he would make that argument. How can short sellers buy 120 shares to cover their shorts if there are only 100 shares in existence? Here's the answer. Remember, if you asked everyone on the planet if they own XYZ, 220 people would say yes. The answer is that there are 220 shares that are available for sale to the buyers who have to cover their short of 120 shares. The amount of shares available for sale is not constrained by the number of shares outstanding. Even though there are only 100 shares outstanding, there are 220 shares that are available to sell to people who are short and need to buy to cover their short. So there's nothing special about 100%. When Jim Bianco says there's a problem when shorts are more than 100% of the float, there's nothing special about that. Now you might say that shorting is philosophically or morally wrong, that the percentage of a company that can be sold short should be capped at a certain percentage. Let's say that it causes distortions in the market, that it causes some kind of manipulation. Okay, that's all fine. I disagree, and that's for a different recording. But my point is, there is nothing special about the 100% number. Any valid criticism you could make about short interest being more than 100% could be made at 50%, 80%, or 120%. There's nothing special about 100%. And this is really springing from that incorrect perspective that if there are only 100 shares that exist, how can short sellers find enough people to sell them 120 shares? And as I just showed you, this is the wrong way to look at it. I just showed you the clip of Jim Bianco. I'm pretty sure I've heard Jeff Gundlach say it in passing. I've heard it from one of the bigwigs who should know better when testifying in front of Congress recently. When you buy shares of a stock, you don't know if the seller is selling you shares that he owns or if he's selling you shares that he has borrowed. Either way, he's delivering shares to you. And if you have a margin account, then you or your broker are free to lend them out again to another short seller. There is no way for you to know if those shares have been borrowed and sold short before or how many times. This is not naked short selling. Naked short selling is when someone breaks the rules by short selling a stock even though he hasn't secured a borrow. For me, the main relevance of the short interest metric is that we know short squeezes exist. And so the higher the short interest, the more likely there is to be a short squeeze at some point. So if you have a position in a highly shorted stock, you'd better understand that possible dynamic. And I would also say you should understand what the shorts are thinking and why they're right or why they're wrong. Personally, I almost never short stocks. I can't remember how many years it's been since I've been short anything. I've had many successful short positions in my life, but let's not just talk about the winners, but the losers. Bianco references the Volkswagen short squeeze. I was personally short Volkswagen when that happened in 2008. I was long the Volkswagen preferred shares, I was short the ordinary shares, and it was incredibly painful. But on the flip side, I shorted less and less after that, and I have no doubt that my bad experience has saved me from getting into many bad experiences since then. And I'm sure that mistake has paid for itself multiple times over. So I've had an expensive education in thinking deeply about short selling. Thanks for listening. Don't forget to subscribe. Good luck out there. Be careful.